Welcome back to the Deep Dive, where we really try to take the complexity out of being truly well-informed. We want to give you those surprising insights, that actionable knowledge, without you getting buried in all the noise. And today, we are strapping in for a really deep, challenging, and I think potentially career-altering look at wealth. But not wealth in the way we usually think about it, fancy cars, huge mansions. We're talking about wealth as this radical, powerful tool for freedom. Our source material for this deep dive is centered, for the most part, on the philosophy of J.L. Collins. He's the financial expert behind the incredibly influential book, The Simple Path to Wealth. Millions of people really swear by his method for achieving financial independence in a straightforward, realistic way. So our mission today is to cut through all those cultural assumptions and pull out the most practical, the most actionable, and maybe the most uncomfortable truths from this whole philosophy. We want to find that shortcut to defining money in a new way, to understanding how to build real, lasting security, and how to avoid the big financial traps that catch most people.
Yeah, and what's so fascinating here is that this is so much more than just a chat about index funds or, spreadsheets. It's really a deep dive into behavioral psychology. It's anti-establishment thinking, in a way. We're going to be directly challenging some of those cultural orthodoxies, especially around debt, home ownership, and yes, we are definitely going there.
Well, we're going there.
And we're going to get into the really emotional side of successful long-term investing. So if you're, preparing for a meeting or maybe rethinking your career path or just looking for that big aha moment that changes how you see your very next paycheck, this is where we start. We're going straight to the core of what money really buys.
Which is what?
Optionality.
Okay, let's unpack that. Let's start right at the source. So Collins, he originally wrote his book, started his blog, just to archive all this information for his daughter, Jessica, which seems like a simple fatherly thing to do. But why was it so critical for him to give her this specific financial framework?
Well, it's the ultimate practical expression of a parent's love, isn't it? He basically boiled down all this life advice to one single, unavoidable truth. If you get money right, everything else in your life becomes so much easier. You gain options, you gain resilience, flexibility.
Right.
And on the flip side, if you don't have those resources, if you're living paycheck to paycheck, life is just perpetually harder. It's more stressful. You have far fewer choices when things, inevitably go wrong. So his whole drive was to insulate his daughter from that grinding pressure of financial scarcity.
And that desire to simplify, to insulate, that leads right to what Collins calls the core cultural misconception about money. What is it that most people get so fundamentally wrong?
The cultural black spot is this. People think about money only in terms of what they can consume with it.
What they can...
Exactly. What they can buy. Just think about the stories we hear about sudden wealth, like winning the lottery. The interviews are always about what they'll immediately purchase. I'm going to pay off debt, buy my parents a house, get a Lamborghini for myself. It's always transactional.
Yeah.
Always about acquiring things. And look, money is an amazing means of exchange. It lets us trade our labor for goods and services, but that's only half of its power.
And the other half?
The other half, the one people miss, is that your money is a tool. Once you have it, you can put it to work. It can make more money for you without you having to do anything.
Yeah. So, okay, this is the big reframing. This is the central idea of the whole philosophy. Instead of just exchanging your time and labor for money to immediately consume it, you divert it. You divert that money into assets. But what's the ultimate goal of that? Is it just to get a big number in an account?
No, not at all. The ultimate purpose is to buy your freedom. It's a transaction, really. You delay gratification now for this massive reward later. See, when you have to exchange your effort, your time, your labor for a paycheck, which is what almost everyone does, you are, by definition, beholden to whoever is paying you.
Right. If you quit, the money stops.
The money stops, and your ability to live just disappears. Collins uses some pretty strong language for this. He calls it a form of soft slavery, not in a dramatic sense, but psychologically, structurally. Your options are limited because you need to earn.
So the goal isn't just about being rich, it's about making work optional.
Exactly. When your assets, that money you put to work, start generating enough income on their own to cover your living expenses, then work becomes a choice. You get your time back. You get your choice back. You're no longer doing a job because you need the money to survive. You're doing it because you genuinely want to. And that autonomy, that freedom to choose how you spend your time, that is the real prize money can buy. It's the ultimate leverage.
That whole concept, the choice between being tied to work or just simplifying your needs, It's perfectly laid out in that opening story in his book, The Parable of the Monk and the Minister.
Oh, it's a brilliant setup. It shows you the fork in the road right from page one. You've got these two childhood friends. They go their separate ways. One becomes this super successful, powerful minister who caters to the king. He lives this life of, total luxury. The other one chooses a different path, becomes a humble monk, and lives very simply on just rice and beans.
Okay.
So years later, the wealthy minister, he's in his finest robes, he runs into his old friend and just feels this immense pity. He says, "Friend, if you could only learn to cater to the king, you wouldn't have to live on humble rice and beans." He just sees it as deprivation.
And the monk's reply is just.
Yeah.
It's the perfect summary of this whole philosophy.
It is. The monk looks back at the minister, who is clearly so tied up in his fancy responsibilities and expectations, and he says, "If you could learn to live on rice and beans, you wouldn't have to cater to the king."
Wow. That completely flips the idea of wealth on its head.
It does. It highlights the beauty and really the strategic power of needing less. If your baseline spending is low, your path to freedom is just so much shorter. If you're comfortable getting by on very little, you need a much smaller investment portfolio to cover those costs. And that means less time you have to spend accumulating it all. It's a shortcut by subtraction.
Let's dig into that a little bit, that psychological distance from money, because this ties directly into the happiness paradox you mentioned earlier. Why do we see so many incredibly rich people who are just profoundly unhappy?
The observation is pretty stark. The people at the very, very top, the billionaires, are often driven by this deep-seated insecurity, a chip on their shoulder, some trauma that fueled their relentless drive to accumulate in the first place. And when they finally get to the top, that insecurity, that trauma, it's still there. It's just magnified by their wealth. Money doesn't solve your emotional problems. It just buys you nicer ways to express them.
So they optimize for the money, but not for the contentment.
Precisely. Look, the anxiety of scarcity worrying about debt collectors making rent, that is undeniably destructive to happiness. Money does remove that specific anxiety, and that's a huge benefit. But once you're past that basic security level, the endless chase for the next validation, the next yacht, the next company, it just becomes a treadmill. The happiness you get from a new purchase is so fleeting, it's a sharp dopamine hit, and then you're right back to your baseline. The key, like the sources suggest, is to create the psychological distance from the stuff. You have to enjoy the journey and appreciate the material comforts as indulgences, but never expect them to bring you core, lasting happiness. If you buy a beautiful new house, the satisfaction should come from the utility of it, the enjoyment of the space, not from this belief that the purchase has somehow fixed your life's problems. If you can keep that boundary, you can enjoy being rich without being consumed by the chase.
Okay, so we've established money as a tool for freedom, and you optimize it by reducing your needs. Now let's get into the practical side, the execution. Collins has a single sentence that basically sums up the entire strategy.
It's the 3 non-negotiables, the 3 pillars. Avoid debt, live on less than you earn, and invest the surplus.
It's so elegant in its simplicity, but it's so profoundly difficult to actually do in our culture. Let's start with pillar 1, avoid debt.
Debt, especially consumer debt, is a ball and chain.
Yeah.
You're essentially paying a premium for a lifestyle you haven't actually earned yet. You can never, ever become financially independent while you're constantly paying interest to service debt. It doesn't matter if it's high-interest credit cards, expensive car leases, or even, huge mortgages.
Right.
And the key distinction to make here is between personal debt for consumption and, say, functional business debt. Business debt, if you manage it right, can be a strategic tool to generate more revenue than what the interest costs you. But that personal consumption debt, that 18% APR on a credit card balance, that is the single greatest wealth destroyer for the average person. It just drains your resources. It makes every single dollar you earn less effective.
So if someone listening is buried under multiple debts, a credit card, a car loan, student loans, what's the mathematically sound way to tackle that? We hear about the snowball method versus the avalanche method.
Collins is a firm believer in the avalanche method
Yeah.
because it's just mathematically superior, period. You have to focus on the debt with the highest interest rate first. It doesn't matter what the balance is. That's the one costing you the most money over time.
Okay.
So you pay the minimums on everything else, and you throw every single available dollar, every bonus, every raise, every dollar you save at that highest rate debt. Every dollar you put there is basically giving you a guaranteed return equal to that interest rate. If your credit card is charging you 25%, paying it off is like getting a guaranteed 25% return on your investment. You can't get that reliably anywhere else, certainly not in the stock market.
That process sounds like it requires some extreme focus, some austerity. What's the hidden reward of going through that intense period?
It's a twofold reward. Beyond just the obvious savings on interest, first, the cash flow you free up once that debt is gone is immediate and significant. You can now point that fire hose of cash toward investing. But second, and I think this is more important, you develop the wonderful discipline of living on less than you earn. You force yourself into a dramatic lifestyle adjustment, and once the debt is gone, that habit of underspending is still there. So that surplus cash just automatically gets diverted to buying assets, buying freedom, instead of buying more stuff.
Which brings us to pillar two, the cultural battlefield. This requires fighting that massive societal pressure to spend. This is what he calls the tyranny of the must-haves.
That phrase is perfect. It perfectly captures that insidious way lifestyle creep just takes over. A must-have is anything that perpetually locks you into a high-expense life. It could be the brand new, expensive leased SUV, the constant need for designer clothes, living in a specific high-cost neighborhood, or feeling like you have to send your kids to a certain private school. The more of these must-haves you build into your baseline lifestyle, the more money you need just to tread water. It creates this ever-rising expense floor that just eats up any raise or any bonus you get, and the likelihood of achieving financial independence, especially early on, just plummets because your surplus, the money you should be investing, it vanishes.
But this flies in the face of what society tells us is success. If someone chooses freedom, maybe they're investing half their income. To people on the outside, that looks like deprivation. How do you square that?
You square it by recognizing the trade-off. You have to understand that you are simply prioritizing a different kind of consumption. When Collins talks about spending half his income on assets, he wasn't feeling deprived. He was spending every dime he earned, but he was consciously choosing to spend those dimes on the one thing he valued most: his future time and his freedom.
Right.
Choosing a lower-cost, high-reliability car, a Volkswagen, say, over a new, depreciating luxury Mercedes, isn't deprivation. It's a strategic choice. It frees up hundreds of thousands of dollars over a lifetime. That surplus can buy you your freedom 10 years earlier. Or maybe you can spend it on travel or experiences or education. You're just redirecting the spending to a higher priority, non-material thing.
The self-esteem trap is what makes this so hard for so many people. That need to project success can lead to some really destructive spending cycles.
Oh, it's a vicious cycle of spending for validation. You feel inadequate or unsuccessful, so you go buy a new high-end TV or an expensive outfit to get that quick temporary hit of dopamine. And for that one brief moment, you feel successful. But then the reality of the credit card bill or the dwindling bank account hits, and you have to sell the item, often at a loss, just to stay afloat. You're sacrificing real long-term security for a 3-day rush of false self-esteem.
Yeah.
And the Ferrari illusion just shows how futile that chase for external validation is. When you're driving an expensive car, you think people are looking at you saying, wow, that person must be so cool and successful. The psychological reality, though, is that they're thinking, wow, I would look cool driving that Ferrari. They're just inserting themselves into the picture. They are not actually thinking about you, the owner, at all. So the purchase completely fails in its purpose if the goal is to get respect or admiration.
All right. Now we get to the most controversial claim in this whole philosophy, the one that runs completely counter to the fundamental American dream story. If your goal is accelerated financial independence, you probably do not want to buy a house, especially early on.
This is genuinely a hard one for people to accept because we are conditioned from birth to believe that home ownership is the defining mark of a responsible adult and a guaranteed way to build wealth. But if we're prioritizing freedom and capital efficiency, a house can be a massive psychological and financial anchor.
Yeah.
The way it works is simple. Houses dramatically and often invisibly inflate your cost of living. When first-time buyers go to a bank, they are almost always approved for the most house they can possibly afford.
And why is that?
Because the bank makes the most money that way, the real estate agent gets the highest commission, and the government gets higher property taxes. The entire system is designed to push you toward maximum leverage.
So you end up stretching to buy, using every bit of your borrowing power, and you're creating this huge financial burden right from the start.
Absolutely. And this gets to the critical difference between variable costs and predictable costs. When people argue that their monthly mortgage payment is the same as their rent, they are often comparing apples to very expensive, very variable oranges.
What do you mean?
Well, rent is a predictable expense. Let's say it's $2,500 a month. You know that's the number for the whole lease. But a $2,500 mortgage payment is just the starting point for home ownership costs. You immediately have all these endless variable expenses: property taxes, insurance, higher utility bills because you have more space to heat and cool. The immediate pressure to renovate because the house isn't quite perfect, then furnishing all that new space, landscaping.
And the dreaded maintenance costs.
Yes, the maintenance is the silent killer of wealth accumulation. Unlike a renter, where the landlord handles those massive unexpected costs, the homeowner eats everything. We often tell people to budget 2% to 4% of the home's value every year for maintenance. But these costs don't come evenly. You might go 3 years with nothing, and then bam, you suddenly need a $20,000 new roof, or a $15,000 HVAC replacement, or a $25,000 new septic system. These sudden, non-negotiable expenses can wipe out months or even years of savings that you could have been compounding in the market.
Okay, but I have to play devil's advocate. Isn't there a huge psychological benefit to ownership?
Yeah.
The stability, being able to remodel, the defense against rents always going up. Doesn't that justify the cost?
That is a critically important counterargument. It brings us right back to priorities. If your highest priority is stability and customization, then yes, buying a house is an excellent choice for you. But you have to recognize that that stability comes at the expense of capital efficiency and flexibility.
Right.
And that flexibility, especially when you're young and your career is dynamic, is so valuable and so underrated. Let's say you get a phenomenal 6-figure job offer, but it requires a cross-country move from, I don't know, Plymouth to San Francisco. The renter can just finish their lease, maybe pay a small fee, and move. The homeowner is psychologically and financially anchored. They're facing guilt, logistical stress, and the massive project of selling a house.
And the transaction costs of selling are huge. They often wipe out any gains you thought you made unless you've owned the property for a very long time.
The transaction costs are devastating. When you sell, you're paying realtor commissions, often 5% to 6%, plus closing costs, title fees, maybe thousands in repairs the buyer's inspection demands. Getting in and out of an apartment is clean. Exiting a house is an expensive, drawn-out mess. And if the market is soft when you need to move, you might be forced to become an accidental landlord, which is a full-time, high-stress job you never asked for, and it just complicates your taxes and your life.
So let's look at the data on real estate as an investment. Why is that conventional wisdom property as an asset kind of failing for younger generations?
Historically, real estate success has been highly dependent on 2 things you can't predict: location and timing. 30 years ago, buying in a boom city like San Francisco was a guaranteed win. Buying in a struggling industrial town like Detroit was a financial catastrophe. But the sources point out that this dynamic flips. Now, Detroit is having a revitalization, while parts of San Francisco are facing challenges with crime and high taxes. Nobody saw that reversal coming. When you buy a broad index fund, you are inherently diversified away from that single city risk.
I see.
And the macro numbers really show the difficulty. While U.S. home prices have climbed over 300% since 1980, way outpacing inflation, median wages have only gone up about 15% since 2000. Houses have become assets only for people who are already wealthy. And when mortgage rates, like they did in 2023, surge past 7%, the cost of borrowing makes the asset less and less effective as a wealth builder for people still trying to accumulate capital.
So the final verdict on houses, according to Collins, is that you shouldn't see them as a guaranteed investment vehicle for financial independence. They're more like an expensive indulgence, a lifestyle enhancement.
Precisely. If you're already financially independent and can easily afford it, then by all means, buy the house. Buy it because you want the lifestyle, the stability, the ability to customize it. But don't confuse that lifestyle choice with a smart investment that will speed up your path to freedom. The smartest financial move, especially when you're young, is often to rent, keep your capital earning in the market, and maintain maximum flexibility.
Okay, we built the foundation, avoid debt, save the surplus. Now we have to put that surplus to work. And Collins says unequivocally that stocks are the single most effective long-term wealth-building tool in existence. But there's this huge, immediate psychological barrier, short-term volatility.
Yeah, and volatility is the price of admission. It's the cost of getting the highest returns. You absolutely have to internalize this one truth. Stocks are never safe for the short term. If you need this money in the next 5 or even 7 years, you are gambling. Market crashes, pullbacks, those sharp, scary drops, they are not accidents. They are a fundamental, unavoidable feature of how the market works.
Right.
But when you extend that time horizon out to 10, 20, or 30 years, stocks are stunningly, historically reliable in beating inflation and other asset classes. If you look at the 20-year rolling returns of the S&P 500, the worst-case scenario, even if it includes the 2000 tech crash or the 2008 financial crisis, is typically still a positive, meaningful return.
So success is really 100% about emotional mastery, not financial genius. When the market drops 30%, how do you actually stop yourself from looking? Or worse, from panic selling?
Yeah.
I mean, isn't that emotionally impossible for most people?
It requires a strategic psychological defense. You have to reframe volatility as a gift. It's a sale. If you can excel when the market is down, you are locking in your losses. You are guaranteeing that you will be, as the source says, bleeding on the side of the road when the eventual recovery starts. You have to commit beforehand to ignoring the noise and just continuing to invest automatically during the downturns.
So you're buying shares on sale.
You're buying on sale. The best investor is the one who puts their money in a total stock market index fund, sets up automatic contributions, and then genuinely forgets the password to their brokerage account. The less you tinker, the less emotionally hijacked you become, and the better your results will be.
You know, that leads to that fascinating data point about how men and women invest. If the key is less tinkering and more discipline, why do studies consistently show women tend to get better long-term returns than men?
The data from places like Vanguard and Fidelity is really striking. Men, maybe it's societal pressure or internal biases, they tend to trade about 45% more often than women. And all this constant trading, trying to time the market, picking individual stocks, making quick decisions, it just incurs higher fees, generates higher taxes, and inevitably leads to timing mistakes. Men also tend to invest in riskier, more volatile assets, which makes their portfolios much more erratic. Collins suggests this behavior is sometimes because men are putting their masculinity on the line, trying to prove there's some kind of market genius. Women, on the other hand, tend to show more caution and patience. They let the money sit and compound, and that results in lower volatility and demonstrably better long-term performance. The ultimate takeaway from someone like Charlie Munger is true. The worst thing you can do is get in the way of compounding.
Okay, let's talk about that magic engine, compounding. Jack Bogle's advice was simple. Invest in the S&P 500 and don't open your statements for 20 years. Can you walk us through the math and the psychological impact of that hockey stick effect?
Compounding is not simple interest. It's growth on the growth. And for a long, long time, the growth chart is, well, it's disheartening. The line showing your contributions tracks almost perfectly with the line showing your total portfolio value. You look at it after 10 years and think, I've put in $60,000 and my account is only worth $80,000. This is so slow.
Right.
But then the portfolio hits this inflection point where the accumulated growth starts to generate more income than your annual contributions. And that's the hockey stick.
Or it takes off.
It takes off. Let's run the numbers. Say you're 25 and you start investing $500 a month. If you get an average annual return of 8%, which is historically pretty reasonable for the U.S. market, in year 10 you've invested $60,000 and your portfolio is worth about $88,000. Okay. In year 20 you've invested $120,000, but now the portfolio is worth about $295,000. The growth is substantial now. But in year 35, when you stop, you've only invested $200,000 of your own money, but the portfolio value has exploded to over $1 million. The growth itself delivered over $850,000 of that. That growth phase is just exponential. It builds on itself so quickly in those later years that a lot of people who are mathematically independent still struggle to believe it. They look at their statements and think, how? How did the market make more money for me this year than I earned at my entire job?
That's the psychological hurdle. I mean, people who spend $100,000 a year and have $5 million invested, which is comfortably double what they need by the conservative 4% rule, they still ask, am I really financially independent?
Yes. They struggle because the math seems too good to be true. The wealth arrived faster than their emotional framework could process it.
Okay, so given that we want low costs, low effort, and maximum reliability, what is the specific investment vehicle that's recommended?
The recommendation is unequivocally for broad-based, low-cost stock index funds, specifically the total stock market index funds like Vanguard's VTSAX. So VTSAX holds positions in roughly 3,600 publicly traded U.S. companies. When you own VTSAX, you're not betting on a single stock or a single sector or even just the top 500 companies. You're investing in, well, in America itself. Every employee from the factory floor to the CEO is now theoretically working to make you richer because you own a tiny fraction of their output.
Can you help us clarify a little technical point here? Why VTSAX, the total stock market, versus the more common S&P 500 funds, like VOO?
That's a great question. The S&P 500 tracks the 500 largest U.S. companies. The total stock market index includes the S&P 500, but it also includes all the medium and smaller size companies, the next 100 of them.
I see.
The benefit of VTSAX is twofold. First, it ensures you are fully diversified across the entire economic spectrum. Second, it captures the growth of those smaller companies, which, while more volatile, often have higher growth rates before they mature into those S&P 500 giants. It lets you participate in the entire life cycle of American business growth. It just provides marginally better diversification and historically slightly better returns, though honestly, both are excellent choices.
And what makes this strategy so resilient compared to, say, an actively managed fund or just trying to pick winning stocks?
It's the self-cleansing mechanism of a cap-weighted index. Cap-weighted just means a company's representation in the fund is determined by its total market value. If a company is doing well, its value goes up, and you automatically own more of it. If a company starts to falter, it naturally shrinks within the fund until it eventually just drops out, and it gets replaced by a successful competitor. Think about the history of retail. For decades, Sears was the juggernaut. It was the Walmart and Amazon of its day combined. If you only owned Sears stock, you would have had to predict its failure and then actively move your money to the new players. If you own the total stock market index, when Sears faded and Walmart and Amazon rose, you automatically owned them without having to do a single thing or pay a broker. The index constantly dumps the losers and embraces the winners for you.
Let's touch on asset allocations, not just stocks. How do bonds fit into this simple path?
Right. Bonds are basically debt. They're money you lend to a company or a government, like with U.S. Treasury bonds, and they pay you interest. They serve one crucial purpose: stability. Bonds are significantly less volatile than stocks, which makes them safer for the short term. However, over the long term, they historically struggle to outpace inflation, so they're less effective at actually generating wealth. Stocks are more volatile, but they're the only reliable way to guarantee your money keeps pace with or beats long-term inflation.
I see.
The allocation is highly personal. It depends on your risk tolerance and your time horizon. Collins, who was aiming for aggressive growth, he favored a very high stock concentration. His personal model was something like 80% stocks, ATSAX, 15% bonds, a total bond market index fund, and 5% cash in a money market fund. Someone closer to retirement or with a lower risk tolerance might use a 60-40 or 70-30 stock-to-bond ratio.
Sure.
The key is to understand that bonds are the brake. They're there to slow down the volatility of the ride.
Okay, we need to bring back the beer and foam analogy now to really distinguish between investing and speculating.
Yes, this analogy is so important for emotional control. Just picture a glass of beer. The price of any stock or any asset is made up of two things: the beer and the foam. The beer is the fundamental operating value of the company, its core intrinsic worth. It's based on sales, actual profits, cash flow, assets. This is the stuff that people like Warren Buffett and Benjamin Graham obsess over. The foam is all the other stuff. It's speculation, hype, emotion, fear, and greed. It's the volatile, fluctuating sentiment around the stock.
So if I turn on the financial news and I see prices jumping up and down every minute, I'm basically just watching the foam dance.
Exactly. Trading actively, trying to time the market that is playing exclusively with the foam. It's gambling. For example, a company like Tesla, with its huge vision for autonomous cars and humanoid robots, it often has a huge amount of foam because its stock price reflects massive speculation on future unproven success, not just its current profits. If the business execution is flawless, that foam eventually settles into more beer and the price is justified. If not, the foam just evaporates, the price collapses, and the speculators are left holding the bag. True investing, like what Collins recommends, focuses on just acquiring the beer, the underlying value, through broad indexes, which are inherently valued based on the collective economic output of 3,600 companies. That just dampens the impact of any single company's foam.
A quick note on Bitcoin and crypto, which seems to be mostly foam. Where does Collins place that?
He consistently views Bitcoin and other cryptocurrencies as pure speculation, not as an investment. An investment, by his definition, is an asset that generates returns based on productive output, like stocks, or pays reliable interest, like bonds. Bitcoin doesn't do either of those things. While its price has provided stunning returns for early buyers, that required prediction, not fundamental analysis. It's simply too volatile to serve as a reliable currency or a store of value. It exists entirely in the realm of hype and hope, which is, pure foam.
Okay, we've built the wealth, now we protect it. Let's start with leveraging government incentives through tax-advantaged investing. Using the U.S. system, the 401k, the IRA as our main example.
Right. The government essentially rewards you for saving by letting you shield your funds from immediate taxes, which lets your money grow much, much faster.
How does that work?
The main benefit is tax deferral. Just consider the difference between investing pre-tax dollars, like in a traditional 401k, versus post-tax dollars. If your marginal tax rate is, say, 50%, combining federal, state, and payroll taxes, and you contribute the 2024 maximum of $23,000 to a 401k, that entire $23,000 is compounding. If you took that same $23,000 as cash first, you'd lose half to taxes, leaving you with only $11,500 to invest. The larger starting base just compounds so much more powerfully over 30 or 40 years.
But the big catch is that these taxes are only deferred. They're not avoided. You have to pay up later.
Exactly. You have to pay the piper. Taxes must be paid when the money is withdrawn, which usually starts with required minimum distributions, or RMDs, around age 73 in the U.S. So the entire mathematical benefit of this deferral hangs on one critical assumption, that you will be in a lower tax bracket in retirement than you were during your peak earning years. And for most people, that assumption holds true. When you retire, you stop getting a high salary, so your taxable income drops, and you pay a lower rate on the money you pull out. However, Collins points out that this strategy actually failed for him and for other people who achieve immense financial independence. If your investment portfolio is so successful that your withdrawals or your RMDs push you into a higher tax bracket in retirement than when you were working, you actually end up paying way more tax overall than you originally saved.
So understanding that nuance naturally leads to the appeal of the Roth IRA or the Roth 401k.
Right. The Roth vehicles just flip the calculation. You contribute money after tax, so you pay the tax up front today. But the huge benefit is that the money then grows 100% tax-free, and all your withdrawals in retirement are also tax-free. So if you're young and you believe you'll be in a much higher tax bracket later in life because of your career or successful investing, the Roth is mathematically the better choice, assuming you can afford to pay the taxes now.
Now let's talk about a powerful wealth-building hack for people with kids. The Roth IRA for kids who earn a modest income.
This is a phenomenal, almost generational wealth hack. If your child earns income from a legitimate job mowing lawns, working at a restaurant, whatever it is, they can contribute up to their earned income or the annual limit of around $7,000 into a Roth IRA.
I see.
And because their income is so low, the child pays minimal or even zero tax on that income now. But that base contribution made as a teenager then gets to compound tax-free for 6 or 7 decades. Even a modest contribution of, say, $5,000 at age 16 can grow into hundreds of thousands of tax-free dollars by the time they retire, just because time is working its unstoppable magic. #the financial advisor dilemma.
Moving on, the choice of whether to hire a financial advisor is...
Yeah.
It's complex. Collins suggests that by the time you know enough to choose a good advisor, you probably know enough to just manage the simple path yourself. Why is the industry model so often a conflict of interest?
The core conflict is in how most advisors get paid, which is primarily through the assets under management, or AUM, fee model. It's typically 1% annually. And let's just run the numbers on that 1% fee. If you have a $1 million portfolio, the advisor earns $10,000 a year. That might not sound like a lot, but you have to understand the compounding effect of that fee. Over 30 years, assuming a 7% market return, a 1% AUM fee on a $1 million account will cost the investor well over $500,000 in lost capital and lost compounding growth. That's an enormous sum, and it directly undermines the compounding engine you spent decades building.
And how does that compensation model create a direct conflict when you're asking for advice?
Well, imagine you have that $1 million portfolio and also a $500,000 high-interest mortgage. You go to your advisor and ask, should I liquidate some assets to pay off this debt, which is costing me 7% a year? The honest, mathematically correct advice might be, yes, pay off the debt. But if you pay off that mortgage, the advisor's AUM drops to $500,000, and their income immediately gets cut in half, from $10,000 to $5,000. It is extremely difficult for a professional who might be dealing with their own financial pressures, a divorce, college tuition, buying a new boat, to give you advice that results in an immediate 50% pay cut for them. You, the client, have to understand the incentive structure. If the advisor is not paid as a fiduciary who operates solely in your best interest, then you have to be skeptical. #the divorce destroyer.
Finally, we have to address maybe the most devastating, overlooked threat to wealth, divorce. The financial toll is so much more than just lawyers' fees.
Divorce is a financial catastrophe, even for the extremely wealthy who have high net worth prenups. Collins shared this devastating story about a friend of his worth over $500 million, where the proceedings just dragged on for 5 or 6 years.
Wow.
The whole structure of the divorce process incentivizes maximum conflict and maximum cost. The wealthy spouse often has to pay for the ex-spouse's legal fees as well as their own. So the lawyers on both sides have no incentive to end the process quickly. They're financially rewarded for just dragging it out and complicating everything.
Right.
Furthermore, they maximize the split by inflating the subjective value of assets, especially things like private business valuations.
Hmm.
If a private company is generating $10 million in revenue, a lawyer might successfully argue that its potential makes it worth $500 million, and then force a settlement based on a valuation that far exceeds the company's ability to generate cash. The courts then mandate a split, maybe 50-50, maybe 60-40, that the wealthy spouse has to somehow fund.
And this often requires forced liquidation of highly appreciated assets, which creates a massive immediate tax hit.
That is the ultimate financial blow. When you buy stock for $100 and it grows to $10,000 over 20 years, your basis, the original purchase price, is low. You only pay capital gains tax when you sell. If the court forces you to liquidate half of those long-held stocks to pay the settlement, you suddenly trigger this gigantic capital gains tax liability that would have otherwise been deferred indefinitely. The cost of the divorce isn't just the settlement, it's the accelerated, mandated tax payment you have to make to the government. And this is all complicated by different state laws, like community property states, which mandate a 50-50 split, versus equitable distribution states where the court tries for a fair split. The lesson is profound. Choosing a spouse is probably the single largest financial decision you will ever make. You need to be intentional. Even if you don't sign a formal prenup, the government has a default contract for you. It's marriage law, and you better be aware of its terms. #outro.
This entire deep dive has been a real challenge to conventional thinking. We've summarized the core mission: avoid destructive debt, prioritize freedom over material stuff, leverage the power of simple, low-cost index funds, and just maintain the emotional discipline to ignore the market noise.
And if we connect this all back to the philosophical core, the true value of this whole structure is acquiring what Collins calls FU money. It's financial strength. It's independence.
Right.
The power that comes with savings, even a small amount, say $10,000, is immediate. That amount gives you the leverage to walk away from a toxic job, to survive for months while you look for a better opportunity, or just to negotiate your terms because you're not desperate. That small cushion instantly shifts the balance of power in your life.
And this idea that the benefit is immediate, that's such a crucial psychological lever. Because we know that our future self, the 65-year-old version of us, feels like a total stranger. It's so hard to sacrifice today's comfort for a person who feels as distant as, Matt Damon in a sci-fi movie.
That is the core insight that keeps people stuck. Collins realized he wasn't doing this for 75-year-old JL. He was doing it for 25-year-old JL. When he first accumulated a modest sum that let him quit a job he hated and go travel Europe, the benefit was felt right now. The savings benefited his current self by giving him immediate, actionable freedom and control. The psychological advantage of autonomy starts the moment you start saving, not 40 years from now.
Before we close out, let's just sit with those final philosophical reflections you shared. They give such powerful context to this whole pursuit of freedom and time. When you look back now, what were your deepest regrets related to time, choice, and priority?
Yeah, regrets are tricky. You can never know if the other choice would have been better. But two incidents really stand out because they taught me these indelible lessons about empathy and presence. The first and less significant was a childhood moment. My father, who was very handy, gave me a beautiful jigsaw for Christmas. He had clearly chosen it and wrapped it himself. And I, being a completely ungrateful child, immediately rejected it because it wasn't the exact thing I wanted. I remember seeing the immediate, profound hurt on his face. In hindsight, I regretted optimizing for the thing I wanted instead of just acknowledging and appreciating the love and the time that went into the gift. It was a premature lesson in the spending trap, valuing the material thing over the emotional moment. The second, and much deeper regret, was a moment I failed to be truly present. I was 24, and my father was in the hospital, dying. The day before he passed, he looked me right in the eyes, sat up on the edge of the bed, and said with total clarity, "I'm going to die now." It was this momentous, profound invitation to have a real conversation about life, death, legacy. But I defaulted to the cultural platitudes. I said, "Oh, Dad, don't talk like that. You'll be fine." I regret that I prioritized my own emotional avoidance over recognizing that he wanted to share that vital, final experience with his son. I regret prioritizing my comfort over his need for connection at the most critical moment of his life.
That is a profound connection. It really highlights that the financial decisions we make, whether we choose the fancy car or the index fund, they ultimately determine how we spend our time and where we are present for the truly important moments.
Absolutely. If we connect the financial pursuit to the philosophical end, what actually matters. Ultimately, on a cosmic scale, nothing. There is no external profound meaning waiting for us. The point isn't cosmic significance. The point is simply to optimize the ride we're on, make it a good, fun ride, and fundamentally to treat people well along the way. That and protecting your time, those are the only assets that truly matter.
That is the perfect thought to carry forward. If you are listening today, remember that the goal of the simple path isn't some vague dream of being rich at 75. The goal is the immediate psychological strength and optionality it gives your current self. What immediate freedom could you buy today? What toxic obligation could you escape? What new opportunity could you pursue by diverting 50% of your next paycheck into your freedom engine? That is the immediate payoff of financial discipline, something for you to deeply consider as you prioritize your own journey toward wealth and independence.